Good morning and welcome back to the Redhedge Podcast. Once again, I'm here with Voon and we are going to try to identify any threats that we could possibly identify in the upcoming months and to look back at the summer, because the last time that we spoke was just before the summer, what happened and what we're going through right now in the financial market. So, Voon, from June, what is the highlights? Market treated us fairly well in the beginning, right?
Well, I would say yes, indeed. From June, July, we actually saw markets being very benign. There's a lot of calm in the markets where we saw spreads and risk in general traded much better. But like we've been saying, I think in our previous podcast that levels and spreads are very tight even then, and the risk reward for being long was pretty skewed because we've come a long way and everything is trading at the tights, and markets are in general being very complacent about risk. So which meant we saw, when it was in August and even in September, where spreads started to go wider just merely because valuations was very tight. What did you think?
Yes, because we have had, just to go back, we had a very strong June, and then rates sold off quite aggressively for the first time in a while. And because it was summer, bonds and credit overall didn't move much. So protection, so crossover main was relatively stable, moved in line, and evaluation, which were technically driven very, very tightly, remained very, very tightly. And when bonds and treasury bounced back, the rates component actually credit got even further tighter. So we started September where credit was at the tights, perhaps, of the period, and then we have had again a sell-off driven by rates volatility. So for me, and I don't know for you if it's the same, but for me, this 3% level on bond and 5% level on treasury are very, very key levels.
Critical levels.
Critical levels.
Yes. Well, they haven't been breached. I mean, I think bonds briefly breached 3%, but now it's trading below, and the treasury is yet to reach 5%. But it's getting a lot of people very worried about this. Also, we saw the return of volatility as well, right? Which has gotten a lot of people quite worried that maybe a risk premium is not really priced in, and we should be pricing a little bit more risk premium. I think the market really started to wake up to this and realize, well, I'm not really getting compensated for my risk here. Risk premiums are too low, and therefore things should go a little bit wider to at least compensate or to reflect this fact that
there is emotions on the table right now. I mean, remember 3% just before 2011 and the European crisis kicked in. Correct. Then we have had Treasury at 5, 2007, Lehman, and the biggest financial crisis of all time, I think, happened. And this year, I always like to look at investors sitting down when I picture myself to take a decision and say, what the other investment committee are doing in any kind of different company. And I look at SVB that happened in March this year, and that as a reminiscence of what happened in the Lehman crisis at the time with the Bernstein at the beginning of the year. And then months later, Lehman. I'm not saying that this is what will happen again or what people think that will happen, but there is this psychological factors and the emotions. And we felt through the whole year, big investors stayed off the table somehow, on the sideline waiting. Everyone was waiting for outflows, sell off, and being bearish generically. But having said so, ETF, passive, private banks, but even active investors had inflows, and so everyone was forced to buy, dragging this spread tighter. We living in the paradox of paradox, is it correct? Paradox of the market, which feels like bonds and credit are back of pre-Salmon Brother mentality. So I buy bonds because it's not a risky asset, but it's not like that. This is, I believe personally, is is because central bank were so involved and supported the market, which gone huge since obviously, and of course with all different kind of subordinated debt, which we actively invest on ourselves. But the idea is that the risks and the complexity and the volumes are much bigger.
Absolutely, the market has gotten way bigger, and you really hit the nail on the head with the end of QE. Basically, like we saw QE ending, CSPP ending. When was it? In the summer this year,
July.
and the market has been so used to having the QE programs, especially in Europe with the CSPP supporting credit spreads and supporting credit valuations. But we started to see, in credit, it hasn't really been that prevalent. But say, for example, in the Govie space, we saw BTP Bund spreads have widened quite a lot recently. Like it came from tights of around 170, even 165 area. Not too long ago in the summer, and now it's trading just below 210. So we're talking about a 50 bip widening in just the last couple of months.
And there was the big BTP Valor replacement of
Correct.
retail,
So on top of that,
which is usually helps because you're taking off
lot
the
of
institutional
correct.
shoulders. Yes, basically with the retail issue of BTP, you take out pressure from institutional investors into the Italian retails, which they place their records of many billions. I don't know if it's closed now, but it's not important. The fact is that we can see we perceive the support of SEB was important and it's not priced in. The lack of it, at least, is not priced in right now.
Well, but as you mentioned earlier, that how investors thinking, like how investment committees are thinking. What are people doing? Let's address the elephant in the room: recession. Are we going to get a recession? Is it coming? When is it coming?
Again, to me, and every day that the financial rate is higher, so the idea is if Bund is at 3% and Treasury is close to 5%, and I'm a high levered entity and like high yield, which obviously is going to be, regardless, more expensive to refinance, and riskier, less likely, because obviously spread are wider overall. So I think that the decompression between very stable issuers, which they don't have really funding problems, and issuers that have a funding issue and have a cost and a risk of not being able to refinance, I think the risk premium of those entities is unacceptable right now. I wouldn't touch them.
Are we talking about more high-yield companies?
High-yield companies, which are tight compared to IG, I think right now.
With their cash flows, that is not necessarily correlated with rates. So cash flows are not really matching where the new prevailing funding rates would be. These are the guys who might get in trouble, like we saw in the real estate sector.
Exactly the obvious sectors were already well flagged. Real estate, chemical company, the conflict,
cyclicals,
the cyclical names, auto, and so on. Still, even the cyclical names, I don't think gives enough premium right now because again,
not yet.
The recession is priced a very soft landing recession, a soft landing overall. But which are the business that are gonna suffer from this environment? We don't know yet. How much the default rate is gonna go up? We don't know. We're basing our approach on data which are worth nothing really, because the past 3 years default rate and the next 3 year default date, it would be a very, very different number. This is a fact.
Correct. Yeah, we can't use just because default rates have been very low in the last prevailing 5 years doesn't mean the next 5 years would be good. Also, we have to be aware that the maturity wall for a lot of these high-yield companies really kicks in somewhat next year or the year after. So a lot of these guys, they have been able to refinance during the low yield periods back in say 2 years ago or a year ago, and then some of these bonds has to be refied soon, and this is when we will start to see the pressure come on, because then they would have to struggle. They would probably struggle to refi at a much higher rate, and the market may or may not have the appetite to be investing in lower quality cyclical high yield names at the time.
I feel right now it's almost a gamble in a way that we don't actively invest in high yield, but what we do, I look at them in a way that I see that whoever has a risk of refinancing, imminent risk, is untouchable. There is no bid for it. But any issuer which has to be refinanced within a couple of years,
Yeah.
everyone wants to buy them. And it's almost a gamble to me because it's good now, but what about when they're going to approach that line?
Correct.
And this is what I believe at some point everyone will want out at the same time, because there is going to be a catalyst, there is going to be something which gets the market to be panicking. And here maybe a question to you, which I generally do not know the answer, is the fact is that CTAs and quant-driven strategy this year have been receiving record inflow post 2022. I believe most of those strategy are momentum driven. So 2022 was very good because the trends were long. Trend is your friend kind of trade. Long weakness followed by long strength. And so in terms of days. And so those strategies return very, very well. And so the hype is there. And this year we've seen that those strategies, which are much bigger, are creating big technicalities. What can go wrong? That is my question.
I think the biggest worry for me is that these trades are almost self-fulfilling. Like, for example, if they want to go long risk, there will be sellers of protections in size, and they will keep selling as long as CDS indices keep going tighter. So they keep adding to this trend and adding to this trend. But you could have a catalyst, which could be anything, and unknown that happens, that suddenly reverses this trend. It could be a vol spike, it could be equity sell-off, or even a commodity spike, that suddenly in their models, they start to unwind. And then when this unwind, it triggers other unwinds as well, and it exacerbates this process, which makes the moves a lot bigger and a lot prolonged as well. It causes a lot of unnecessary, I would say, volatility in the market, because now that the deal sizes are much bigger than what market makers are, which means market makers wouldn't be able to absorb this kind of risk, and they would push these markets a lot wider. And because they all trade, these CTAs, they would trade across all major markets, and they makes it all a bit more correlated. So no problem is kind of just isolated within itself. So I think this is the main scare. You could get something like a virtuous or vicious cycle, rather, in the sense where it goes wider, which leads to something else being sold, which then leads back to credit being sold, equity being sold, and it comes out in a cycle, which we saw actually at least recently in the sell-off, because we saw all asset class, rates, credit, and equities all getting sold when volatility was spiking a bit. And it's driven in part, I wouldn't say all, by CTAs, but by risk parity and by CTAs. And so these guys it just exacerbates these moves in the market and makes it very, very difficult for investors to understand or even to trade in these kind of markets.
It looks like a bit of a sci fiction where machine buying machine. Beginning of the year, AI buying AI stock, a quant-driven fund buying driven stock, and then momentum is driven by AI, and AI follows momentum and amplifies that.
It's like in 87 with the Black Monday, was it? With the crash where they had this portfolio insurance, and then so it keeps on propagating the same thing. Yeah,
and I see the risk there. I see when the system breaks, and it will break, we'll have a bump in the road. The gaps of liquidity would be much bigger than we used to. Remember, compared to the past, the market is bigger. Positions are more concentrated with these issuers and with these strategists. And the balance sheet of liquidity of investment banks, which are providing the liquidity to, are non-existing compared to pre-Lehman, really. And so the next liquidity gap will be huge. Now, obviously, we've seen with COVID, central banks stepped in and caused inflation perhaps as well. Now we are in the worst kind of period of because central bank cannot step in as fast unless there is a big problem, because otherwise it would be inflationary and it would be very difficult to to tackle inflation once again. So we postpone the problem, and at the same time, so we need a big catalyst to get them to step in. So anything in the middle can move prices quite much wider and very aggressively, I believe.
And also with the valuations being tight, I mean, all these things that we've been mentioning, recession risks, risks of default, in a way that we would call them a known unknown, I guess, because recession, we know it's always this risk lingering around. What about the unknown unknowns? Like, for example, the tragedy that we saw in the weekend, which is,
I mean,
the humanitarian crisis.
Was going to be my next point. I mean, in the last few years, because, what I really don't understand is how can we trade so tight when, look at that, COVID. Everyone became a virologist, an expert on virus within a few months. Then Ukrainian and Russian war, and everyone had to become an expert in diplomatic balances, NATO rules and pipeline going around the world. And right now, a very recent latest development, this absolute Middle East crisis once again, which can or cannot become a big problem. I mean, how can the spread be so tight? I mean, I understand the absolute yield are higher, and I understand that if you could buy something at 2% last year, now is at 5%, it looks attractive. But how can the level of sophistication and level of fear of the investor be so low? I mean, this morning we had already the conversation in the morning call, me and you. I was the bear, you were the bull, almost into this situation in a way that you thought there was going to be a little bit less, the risk of being a big issue, what happened over the weekend. You thought there was going to be potentially a low probability on a strong escalation. Did you still, after the morning of trading, you still have the same point of view?
I mean, at the end of the day, none of these issues are...
Let's recap for our audience what happened first.
Well, just at the time of filming this podcast, which is now, we saw an escalation, or we saw Hamas launching rockets into Israel, and Israel responding in kind as well. So there's the escalation in the Gaza Strip, which unfortunately has taken the lives of many civilians. We talk about thousands of, which is the worst, I would say, humanitarian disaster or worst crisis in Israel and in the Palestine in the Gaza Strip for a long time. And of course, we all think that what has happened is a tragedy. But as investors, and when we look at this in context of the markets, how we should think about it, I would agree with Andrea saying that the markets at the moment is very complacent about this, barring it being a very unfortunate humanitarian disaster. But the markets at the moment feels like it's an insulated matter, unless we get further escalation with other, powers, maybe the neighboring countries, Iran or the US, starting to get involved in this. As we speak, I'm hearing news flow that the Israeli Defense Forces, the IDF, has already started to mobilize their reservist troops to the tune of 300,000 soldiers, which could signal. I mean, my heart goes out to the people on the Gaza Strip for this, but I would say the market at the moment is, from a market point of view, at least it's has been a bit comfortable with this. But like you said, it echoes what happened during the COVID period, for example, where we knew about the COVID outbreak, say in China, in Asia, for a good 2-3 months before it reached Europe and became a whole global pandemic. Could this be one of those things? I hope not. I actually genuinely hope not. But as as an asset manager, or take, where we look after assets and investments on behalf of our clients, this is not the tail risk that we can ignore, I think. And that's the point really, like how do we then be able to manage this tail risk? None of us hope anything like these will happen, but the reality is sometimes bad things do happen, and we need to be able to be prepared for it. That's my view.
The market all the time, any big breakdown, anytime over the weekend I read the news and I will think the market will open this low on a Monday, is always, in my personal perception, too low. And most of the time happens that the market tries to ignore these factors. I mean, market is long by definition, so they wait before to sell, before to panic, they wait. So usually the first few sessions are quite strong relatively to what happened. And even pricing a escalation risk, it is very, very tail in the beginning. And then investment committee sits down and eventually the price actions start to very drastically change. I always try to be way more cautious in this kind of occasion, just because if a tail risk like that, which for tail risk, I mean Iran and US escalation, it is drastic for the world. And if you combine that with the Russian situation and China on the sideline and Taiwan as a next target, US having to be supporting Ukraine, having to be supporting Israel, and at the same time eventually having to take a decision on Taiwan, it could be something future. We always have to be trading, we have to be investing with some sort of escalation like this on the back of our mind. The whole Redhedge exists because of those protection that we put in place for this very tail risk. The idea for me personally, I think this is more than a tail risk. Obviously, no one wishes that, but we need to price the possibility at a certain level, which that can happen. And in any case, once again, the risk reward being long here is minimum.
Yeah, we come back to the same conclusion, but then again, spreads hasn't really changed that much since the last time we spoke in the summer. It's gone a bit wider, and then we saw very, very strong rallies as well, as the market sometimes panics to buy back risk or to cover hedges. Spreads, albeit a little bit wider than maybe in the early summer, but it is still at very, very tight levels compared to, say, in the last 2 or 3 year range.
What about inflows, outflows? What is the latest data?
I would say inflows has been strong this year, but in the last month or so, we've seen quite a lot of outflows, which in a way is surprising because yields have actually gotten more attractive, but we're seeing mostly outflows coming from US high yield, which has been weak all year, but also in Euro high yield and Euro IG as well. So we think that, my opinion is that I think investors are starting to be a bit more wary because, first of all, I think the rates volatility is scaring a lot of investors. But also, I think investors are feeling that buying credit now, you're really just investing in rates. The credit component as part of the total yield is very low. And if you're starting to get worried in rates, you're going to see outflows in rates funds, but also in credit funds, because credit funds are more like a rates proxy with a little bit of a credit kicker. But you're not getting really compensated for going down from a govie into a corporate with just this extra bits of spread. So that's why I think outflows are being seen, and these guys are rotating out of these funds and also govie funds included into money market funds.
What is the greediness of how much can this greediness be last in the market really? Because the idea is I'm paying fees to be managed, to delegate, to be delegating, managing of high yield portfolios, and the risk is really the pickup in risk slash premium is at a level that I don't find acceptable, but I think is quite obviously unacceptable, and maybe direct managing front-end trades, just cheaper and safer. Can this happen, do you think? Rotation out of high yield into front-end?
It is not a question of can it happen? It's already happened, and it is happening, right? And the thing is, how far more can it continue?
But the question is, someone is going to be left impossible to be like the execution of this trade. Someone will be left behind.
That's the case with the markets all the time. There's always going to be an early mover who is too early, and then a late mover, and the guys who got left behind and taking losses, because at the end of the day, investing is not a zero-sum game, right? Yeah, we have winners together or losers together. So I don't know how long this will last, but this is definitely reflecting that investors are really waking up to the fact that that this risk premium is insufficient, and they are getting more cautious and adopting a more defensive stance, which, in my opinion, is probably the appropriate thing to do. They're starting to look at the world and be like, okay, it's painting too rosy a picture. The market doesn't price in any recession risk. Rates starting to look scary, and then plus over the weekend now we add another geopolitical risk factor into the mix. It starts to look a little hairy here.
There is a lot of moving parts.
Correct.
What I see inflation and higher for longer. Which
and I forgot to mention that. There's another one to the mix,
which is the key.
Yeah,
which moved and generated rates volatility,
correct,
which is the key component. The fact that market was not pricing enough desire for longer generated the rates sell off at near to 3 and near to 5 as a level. Key component. The risk premium, which obviously, but I give you an example. This war, obviously a risk off. You buy bonds, you buy treasury because it's a safe place to hide. But again, this could be very inflationary. Oil price can go up a lot on the back of this new war. And again, inflation is a problem. Central bank won't be in a position to be able to cut as soon as the market expects. So once again, will lead in vol into rates, and it's not such a safe place to hide unless you go in the very front end and you carry into maturity. So there is so many moving parts, which are, it's not clear how to decrypt. I mean, it is clear the risk premium is not there for certain insurers. Is it clear that the market has made mistake in pricing, for example, the central bank cycle? But my question is, when Voon was through 3% and Treasury approaching 5%, why central bank didn't come out with a strong comment from statement? Did they like those levels? Did they want to see market testing those levels? What do you think?
I would think so. I mean, my opinion, they are obviously aware of the situation, and they wouldn't want rates to sell off in an uncontrollable manner. The recent widening we've seen, even though there has been obviously a bit, the price action was also driven by stop losses, I wouldn't say they have been uncontrollable. The volatility has indeed gone up, but it's within the levels that we've been used to in the last 2-3 years, with just higher volatility in rates. So I'm pretty sure the central banks are looking at this and thinking, okay, fine, it is still within the ranges that they think is kind of okay.
Acceptable.
Yeah, correct. In the US, for example, at 10 years approaching 5%, I think that the Fed would still be comfortable there. And unless it goes uncontrollably to 6% or to 5.5%, 6%, I don't think they would specifically come out to talk about this. And also, I think most of the time central banks are more inclined to take care of the front end rates, which is mostly their mandates. However, we saw, for example, last year during the sell-off in gilts, obviously when that became a little bit uncontrollable, or when the BOE clearly felt that the market was not functioning well, the BOE clearly stepped in. So I think the ECB and the Fed would do something similar should something like this happen. For example, in the Kiat sale of last year, where we saw it just selling off 50 pips at one in a session, that and clearly the volatility is way above the band that
of course, they will come in with the
want.
additional problems of swaps and insurance contract to
Correct,
posting too much margin too quickly, lack of liquidity, and increase in the
Yeah.
volatility. Of course, well aware of that, central bank, when it's too big, is definitely too big. So definitely for them, as you say, it was not big enough. This vol is acceptable. Which I agree. And I do think if something bad happens, if recession really hits harder than expected, central bank needs to keep the weapon of communication and actually cutting when is needed,
Correct.
rather than just to come down what I believe is a standard volatility for this market.
Correct. Also, it sends the wrong signal if an ECB or the Fed suddenly comes out and it's almost like they're panicking when the market thinks, okay, it's, there's a little bit of vol, but it's not. It's a panic selling kind of thing. And
it's almost
why
if
is the
the
Fed
central
reacting
bank
to this?
will if they do that, if they say something, they actually admit there is a problem.
Yeah, they're actually signaling that there may be a problem, and we'll be like, why is the central bank panicking here? Is there something we're missing?
And they may receive the opposite effect. We've seen on ACB having the wrong communication pattern many times now in the most recent mandates, and so I agree to your point for sure. Maybe just before to wrap it up, asset classes that we have seen, as we mentioned, high yield, wrong pricing to my point of view, but a strong statement, but I do stand that. There is IG credit. I do think personally senior bonds are still pricing around the level of ACB being fully involved. I do like IG better than high yield, but I do think it's tight because supply wave cool it in case of stabilization, so a little bit of indigestion of bonds, topped up to levels which are overall still tight in spread. Subordinated debt levels right now, we're looking at financial subordinated debts such as AT1, which has been moving in line with their beta, so cheaper, expensive, arguably, but those stuff move and opportunities there either way. Corporate hybrids, so corporate subordinated debt, not really moving. Very resilient, market is shrinking and limited outside there. Just to have am I forgetting anything?
No, I think you covered it pretty well. I mean, I would have summed it up the same, I would say. At here at Redhedge, we continue to be very cautious. We think that the overall levels, like you mentioned, are still pretty tight. There are pockets of value here and there, and we just have to be very selective. But overall, in general, we still think stuff are pretty tight. We have to be very selective and cautious in our investment, I think.
Always.
Yeah.
So what to watch next? Data, CPI data this week. We have a few data coming out to look at and reassess inflation overall. We need to stay tuned for sure in the situation and development of this work and escalation of this.
Absolutely. Hopefully there's no escalation, but
monitor and assess, see US reaction to this and what the Biden will do and how much support we give to Israel. And I think, as always, we will be trying our best to navigate these conditions.
Absolutely.
Well, thank you very much for listening to us, and we hope to speak with you soon.
Thank you very much, and see you guys next time.